One. What's up, everybody? Here we go. Today I'm going to start my indicator series. And I'm going to chat about indicators in Forex and trading and investing in general. Now, these are going to be the same kind of ones that have been basically used across all kinds of trading. So whether it's commodities, stocks and bonds, anything, whatever, garbage Bitcoin or any of that other stuff, and Forex included. Now, before I start, I want to give a disclaimer. I'm not endorsing any of the indicators I'm talking about in this video or any other video in this series. I am going to talk about ones that I've used and ones that I haven't used, but things like I understand about them. But I don't endorse any of them. And if they have a brand name like Fap Turbo or anything else, just in case if it comes up, I don't endorse anything. You guys got to do your own due diligence when you're trying to use anything that's going to play with your real money, okay? So again, anything I talk about is through my experience, and I am not endorsing anything I talk about in this series. Now, the format of how this series is going to work is very basic, actually. It's basic. I'm going to tell you a brief history, as I understand it, if and how I've ever used it, if I like it or not, and why. The pros and cons I feel are the pros and cons of each one that I feel are true. So that's how basically this series is going to go. And I'm going to start with the most commonly used and the worldwide most used indicator is the moving average. Now, the moving average in one form or another, and by different names, is a lot older than 100 years, if I remember from the research. It was called, or has been called, instantaneous averages, process of moving averages, plotted statistical average points, amongst like a bunch of other ones. But it somehow or another got settled with moving average as the name. Now, I think it was 1909 when that name, the moving average, was settled. And the different folks throughout history claim to be the first ones who designed it. I didn't delve that deep into that, but it's over 100 years old. It's been used not just in trading, but in statistics and all kinds of other things. So it's not new. It's pretty old. And who actually invented it and the deep dive of the history is not in the scope of this video. So I'm just going to move on. What it is, though, is more important. And what it is, it's a representative line of data points based on different calculations. Now, if that went over your head, what it does is it takes averages and calculates them, and then it spreads that average over the course of the time you tell it. Now, there are different kinds of calculations, so that means there's different kinds of moving averages. The most common and most used are the simple moving average, exponential, smoothed, and linear weighted. And these are the most common ones. I'm not going to go over how each one is calculated differently. Just go to DuckDuckGo. Don't use Google. They track you. And you go to DuckDuckGo and just look for the information. It's out there and it's free. So I'm not going to go over it here. But yeah, just go do that. Now, in order to use a moving average, you will need to decide on a period. Now, that is basically how many bars or candles will this moving average use to calculate its average. Now, through my years in this venture here, I have met lots of people, talked to lots of people, traders and whatnot, and there is a common favorite set of periods that are used. And if you ever watch anything like Bloomberg, CNBC, Fox Business, anything like that, or any of the guys on the internet too, most of them who are worth anything, any worth or salt at all, will talk about these kind of indicators and their settings because they're the most commonly used. And those basically settings, those favorite periods are 5, 10, 20, 50, 100, and 200. Now, I can already hear you guys, no, I use it. I don't care. So shut up. I don't care what you use. I'm not here to talk about what you use. I'm here to explain moving averages and the most commonly used ones. If you want to use a 23.6 moving average, or I use 119.4 because that's fine. I don't really care what you do. That's great. If it works for you and you make money, awesome. If not, I don't want to hear about it. So, most rookie traders, actually, speaking of you people, most rookie traders use MAs very wrong. To be sure you get it, a moving average is the average price of X, X being what you're trading, euro, gold, silver, palladium, whatever the hell it is, over X time. 20 days, 30 days, 50 days, 2 minutes, 8 minutes, 10 minutes. That's what a moving average is. For example, if I plot a 20 SMA on a daily chart, I want to know what price is averaging over the last trading month, which is roughly 20 days. If I put a 20 moving average on a 1 minute chart, what I'm looking at is the average of the last 20 minutes. Now, be sure you understand that point. I want to knock it home. 200 MA, for example, if I put it on a weekly chart, that's about 4 years. The average for 4 years. Now, that's fine if that's what you're looking for. But don't believe because you saw some guy put a 200 SMA on his chart that you can take that 200 SMA and apply it to whatever time frame you think you're trading correctly. If you put a 200 on a 1 minute, that's 200 minutes. If you put a 200 on a daily, that's 200 days. On a weekly, that's 200 weeks. I know that this sounds simple, and I know it's like, oh, dude, Rick, you're telling us shit we already know. I swear to you, I don't know how many times people have done this. I plotted the 200 SMA on my 5-minute chart, and I'm getting different results. You think I'm lying? All you got to do is visit any forum on the internet that has anything to do with Forex, and you'll read the dumb shit that I've read over the years. Even worse is the people you try to train. Oh, my God. Trust me, I'm saying it because I wouldn't waste my time if I didn't think people needed to understand this. All right? Be very careful on which moving average you use. If you want to look at a 1-year average on the weekly chart, what do you think you should be putting on there? Just guess to yourself, because I don't care. And I don't care if you post under this video. I don't care. I don't care about that. I just want you to know it. Do you think you know it? I'll give you a second. If you said anything other than 52 period, then you're dead wrong. Why? How many weeks are in a year? 52. So if you want to see the average of price for the last year, you put a 52 moving average on the weekly chart. That gives you a year. If you put 200 on there, dummy, that's 200 weeks, which is, again, roughly 4 years, about 3.8 or something like that, 3.7, 3.8. So please use them correctly. If you don't know how to use them, don't ask me. Go figure it out. I ain't got time to babysit you. So, moving on. The majority of traders I've met and read about that had any sort of lasting success. Now, there's a few exceptions, okay? And, excuse me, if there's any now that are out there, I'd love to hear from you. If you have actually traded something that you find that works for you, you don't even got to tell me how to do it. You just tell me what it is. I like to hear success stories. So if you want to share your success story with me, I'd love to hear it. You can, hit me up on Twitter or send me an email at bearforextrading@gmail.com. If you're a subscriber to my Patreon, thank you. And if you have the highest level, you can give me a call, and I'd love to talk to you about it. It's awesome. I love to hear success stories. I don't hear them as often as I'd like because traders who usually make money, they usually don't say anything for good reason, right? But yeah, that would be awesome. I'd love to hear it. Don't put it here on YouTube. Don't post it on there because you're gonna get a bunch of fools talking shit to you. Just hit me up direct, okay? I don't really care about who's on who reads the stuff. Just I want to know directly. Um, anyways, where the hell was I? Oh yeah. So the daily chart is basically the one that most traders trade in general. People do weeklies too, and position traders, monthly charts. Most of the time, they're just looking though on the monthlies. Trading the daily is the most common. Anytime you go to those same TV channels I mentioned before, Fox News and CNBC and all that, they're pretty much they like to look at the daily chart. And again, for good reason, it's the most traded chart, right? You may not execute a trade on it every day, but it's the most commonly used chart is the daily chart. At least that's for anybody who's not a rookie or unless you're ultra specialized. And there's a couple of people I know who scalp and are really, really good at it. I can't do that. That's too much for me. I like trading the bigger time frames because they're slower and more methodical. That's the way I work. The fast, frantic stuff, that's not for me. I tried it in the past and no thanks. But anyway, so the daily chart is the most traded chart from my research and from my understanding. Now, that's why also the most common periods are 5, 10, 20, 50, 100, and 200. Now, why is that, you might ask? Well, there's about 5 trading days a week. So the 5 period would equal a week. And 10 period is 2 weeks. 20 periods is a month. 50 is closer to 3, but they call it the 2-month average. And then 100 is 6 months. And then 200 is a year. Average, of course. There's about actually I think 220 trading days a year, give or take, but they like to use round numbers. Now, full disclosure, just so in case anybody asks, I do have the 200 SMA on my daily chart exclusively. Actually, that's the only thing that's on there. Now, you're gonna say why, and I'm gonna tell you because most pro traders and institutional traders also have it, and I believe, and others also too, is the more common an indicator, the more that indicator is used, the better it works. Now, whether that's true or not, I don't know. It could just be, one of those things, but I find that the 200 moving average is pretty on point, at least on the daily chart, in terms of how it reacts to the market when price bounces over it. If price breaks, it usually goes whatever, right? It could be just a faulty theory, but it's a theory a lot of people believe, and I'm one of them only because I've seen it do things that I believe to make me believe that, right? Whatever. If I'm wrong, I'm stupid. Okay, that's fine. I don't care. And another thing, whatever the pros are using, if Bank of America and all the big hedge funds and stuff, if they have a 200 SMA, sure, they probably have a bunch of different other stuff, and they probably have algorithms too, But if the 200 SMA is part of that algorithm family or it's on their chart, if they use it, I use it, or I at least want it on my chart. And if you don't, then that's your issue, but I think you should, because I do. Because again, we retail traders way over here at the bottom of the barrel, we are never going to move the market. I don't care how successful you are. You're never going to be able to move the market yourself. Our job as a trader is to be the flies around the elephant's butt. That's what we do. We're there to catch a few drops of water as the big elephant splashes around and moves the market. We're supposed to grab a little bit of it because we're little flies. And that's the way we should be, because we can make some decent money and build a life around it. But I use the SMA, the 200, as a telling point, the 200 moving average. Meaning, when price gets to it, is the market trend going to change? Is it going to cross that 200 and then change directions and do other things? I also use it as a profit target when price is likely to hit that level. When price gets around the 200, it's like the equilibrium point. It's like price is always trying to get to 200. The further away it is from 200, in my opinion, the market's oversold. So the closer it gets to it, the market's overbought. So you want that there to kind of like I said, it's like market's attracted to it like a magnet. Now, my trading style, though, is based on support and resistance and momentum on the tech side. And of course, I always pay attention to the news and the overall economies of the countries' currencies that I trade. You'd be a fool not to watch the news and understand there is no such thing as pure technical trading. You're going to lose money in the long run because the news moves the market more than any technical thing you'll ever see in your life. One bad news thing blows tech out the water. If you don't believe me, that's fine. Don't call me crying when you lose a big money trade. I pay attention to sentiment, right, and bias. But again, I'm a trader, not an investor. So I trade currencies. Investing is different, and it's handled differently. And I'll talk about that in another video down the road. But my job as a trader, and yours if you become one, is to capture the meaty bite of momentum swings. Don't fall into the trap of trying to catch tops and bottoms. That's for losers. You're never going to do it. You want to catch a nice chunk of meat in the center, like a filet mignon, that nice drippy, guaranteed, beautiful bite of meat. That's what you want. And that's what I do. Is that the momentum starts moving. I try to capture it. When I feel like it's slowing down, I get out, and boom, I made my money. Now, because I do it on larger time frames, it's not. I'm not going to say it's easier, but it is more accurate because it takes the longer time frames more time to turn around. So long as you know what you're doing. Now I do counter trade too sometimes, but basically, I put on more risk when I'm trading with the trend, which is why I like to have that 200 SMA there to make sure I'm still, if market's under it, it's it's a shorting bias. If it's above it, it's a buying bias, right? Long bias or short bias depends on where it is. I want to be on the right side of it, but if I see an opportunity to grab some on the counter trend side, I take some risk off, but I do still do it. Otherwise, I'm going to be waiting a long time. If I'm waiting for only down trades, I'm going to miss a lot of opportunities. So you should always do both, in my opinion. Obviously, this is all my opinion. You can do whatever you want to do, but that's another story. Now, using moving averages, though, enough of my trading stuff, but using moving averages, it comes with pros and cons, just like every other thing, right? One of the pros, and the best reason to use it, in my opinion, is it gives you an instant visual representation of price over time. If you had to go and calculate this yourself, you're going to spend half the day on your calculator trying to figure out what the 200 moving average is. So that's a good thing about it, is it's instant. You just look, oh, there it is, and this is where price is averaging. So that's a good thing. Now, a con is it is a lagging indicator. And by lagging indicator, it does not predict where price is going. It never has and it never will predict where price is going to go. What it does do is it tells you where it has been over a specific period of time. So there's no such thing, in my opinion, as a leading indicator. Meaning, I've never seen anything that tells you where market is going to go. There's only one that I know of that tells you where it might go. And I'll talk about that in a different video. But they're all lagging because they all need the information that's already been printed on the chart in order to calculate to tell you where it is. There's no other way. It needs current information to tell you. It can't tell what's going to happen in the future, so it can only use what is there now. Okay? Now, another pro, in my opinion, if you stick with the most common periods, the 5, 10, 20, 50, 100, 200, you will be seeing the same chart as most other pro traders and institutional traders, because that's what they all use. right? I never seen any trader have like a 23 or a 66. The pro guys or the guys on TV. No, it's always a 50, a 100, a 200, a 10, a 20. You know, whatever the case may be, right? So I've never seen anybody use any odd numbered things. Most of them use that. Now, the con side is that you should not and cannot, in my opinion, make a trading decision based solely on the moving average. Please don't do that. Don't just have a moving average on your chart and be like, oh, I crossed it, I'm going to go long. Oh, I crossed it, I'm going to go short. You're going to get killed, murdered. Don't do it. Another pro, it's free and available on every charting package I have ever seen. Every trading package I've ever seen has moving averages on it. Whether it's free or paid, you know, Trade Station to MT4 to a Wanda FX Trade to any proprietary one, it's always there. You will always see moving averages. And you can make them in pretty colors, and you can add all kinds of crazy stuff to it, and shifting and all this stuff, all to your detriment, mind you, which is one of the cons about it. See, the con is it's free and available, even though it's free and available everywhere. To your detriment, they let you customize it to exactly how you want it. Now, the way that I see most rookies using the moving average is by throwing a couple of MAs on there, and then they'll also do like some kind of an oscillator. And by oscillator, if you don't know what an oscillator is something like an RSI or MACD, stochastic. That's an oscillator. And they'll throw these together and they'll say, oh, I got a system. Now, I'm not saying that it can't work. I'm laughing because I've seen many fail, but I'm not saying it can't work. But what I'm saying is that you need to be careful and understand what it is that you're looking for and what you're doing, right? Because most of the time, moving average crossovers, once the crossovers happen, the bulk of the move is gone, and you're catching the end of it. Unless it's like a big transition trade, the market's totally going around and changing position. Most of the time, you're only going to catch a little bit, if anything, and then you're going to fail. You're going to end up losing, right? Again, I'm not saying it cannot work, because there's a couple of people who can make it work, right? But so what I'm going to do now, if you give me a second, I'm not going to stop recording. I'm going to set up I got my chart already open here, but I got to turn on my my screen capture, and I'm going to go through a couple of the popular ones that I've used when I was in the past, right? And all I'm going to do is you guys can make your own decision. I'm just going to show you how it's traded, and at least how I learned, or the people who make them, how they said we should trade them, and you make your own decision, right? Now, if that's the style you want to pursue, moving average crossovers, I don't care if that's that's fine with me. Go ahead, right? I warn against it, but hey, it's your money. Now, I'm going to make this very clear. I, Rick from Bear Forex, do not endorse any of the following. My trading style has changed over the years, and I do not trade moving average crossovers anymore. Okay? So let me go ahead and turn on. Give me 1 second, and it should be live in 3, 2, 1. Bam. I think I was on time. All right, everyone. So here we go. We're looking at the Euro US dollar on the daily chart with Wanda, who is my current broker. You'll see that this is actually the 200 that's on my chart right now. But what I'm going to show you is the ones that I'll start with the one I started off with the first time I ever learned how to trade any crossover. And I found it on Forex Factory. And it was from a guy whose username was Bag of Vino. So I probably should have guessed wrong there, that the guy was maybe not all there. But anyway, so the first one I learned was a 5-10. All right, there's a 5. And let me add a 10 here. 510. I like to make them really bright so they stand out. And I thicken them up a little bit. All right, let me zoom in a little bit. Okay. So his was a 510. Now, he also said to use a moving average, I'm sorry, an RSI. So I'm going to add an RSI here. Relative Strength Index. And his was a 14, which it already is. I'm not going to change any of the colors or anything. So the basic premise of this one was that when price crossed over, like right here, let me zoom in a little bit. When price has to close over, but these two have to be, so the white would have to be over the blue, or 5 over the 10. Once that happened, which was here, you're supposed to look down here and make sure price was climbing above 50. Okay? Now, if you see here, it wasn't, because here's 50. If you look, this is not 50. So you'd have to wait another day on the daily chart. I'm using the daily chart as an example. His was on the hour chart, but I will never trade the hour chart. It's way too much work. So here I go. Okay, I'm waiting again. Still nothing. It's down here at 42. Next day. All right, here it is, finally. So I go long at the end of this day. Okay, this is where I go long. Here, at the start of this candle. And I was supposed to put my stop at the bottom of the last swing, which was down here. So you're looking at about 200 points this way. And he always said, do at least 1-to-1. Okay, so that would mean I would need another 200. I would need price to go 211, which it did. So this would be a successful trade. However, what he also said was if price reached 70, which it did right here on this candle, I'm supposed to close. So if I did that, boom, I would have got out right there. Again, this is a successful trade. The problem is, if you look at all this other stuff, none of this would be. Or it would be very hard to turn a profit just because this big swing, see, for example, right here, I'd have to wait till here's price crossed over. But when you go down here, price is at 55. You got to wait till it's under 50. So you'd wait till this one. Was it under 50? On this one, yes, it was. So now you can short it here. Last swing was way up here, 500, right? So let me ask you, if it's 500, this doesn't go 500. It also didn't reach 30. So what am I supposed to do? Well, guess what? He didn't tell us what we were supposed to do at this point. He never said. He just said, get out when you had enough when anybody asked him a question. That's no way to run a business, which is what this is, right? So, okay, you're sitting here. So he said, well, you can get out when price climbs back up and breaks or the next time it crosses over. So if I wait for the next time it crosses over, as an example, that's way the hell up here. So I'm going to turn a winning trade into a losing trade. That sucks. Then his other thing that he said was, if price crosses the 5 or the 10, which would have been in this case here, it would have crossed here, so you can close here. Okay, that's fine. So now I wait till this happens again. All right, I go long here. Last swing down here. Oh no, price collapsed on me. There goes 200 points. And then, here it is again. Price collapsed. But right here, here it is. Price collapsed. Countless times you'll see over and over again where price, really, if it was me, you're supposed to get in here. But this guy says, no, you got to wait, right? You got to wait. So, all right, look at this mess. This is a mess. You shouldn't even be in here. There's no reason to be in here. And then what happens later when price gets all tangled, like this? How many times are you going to get in and out and take a loss? So again, if you're okay with that, if it makes it work for you, then that's great. You know, if you think it's enough, if you're happy with the results, then that's fine. I just think it's a lot of headache. And granted, this is on a daily, which actually produces a lot better results than say the hourly or the weekly or anything like that. Believe me. I'm gonna go over one more really quick. One's a different one that would be one that a colleague of mine introduced me to, and it's, you know, again, it's a crossover, so I'm not really hyped on it, but he likes it for the daily chart, and it's a little bit slower. So this one is a 50 and a 200, and he uses. Did I get rid of it? Oh, I did. Okay, and he uses stochastic. He likes the 1433, which it's already there. So this one, what he likes to do, again, he does it on the daily chart. Now we'll do the same thing. The same thing. This is the same area here again. Okay, the same. I believe it's the same area. Yeah, it's the same area. So what he does is, let's take right here for example. What he likes to do is he'll take when price closes above the 50, and this and the stochastic is above the 20 line. He'll take a long. In this scenario, he would take a long, and his price target would be the 200. And the opposite for the opposite way. So, for example, if he took this trade here, he would get in right here, and he'd set his stop at the swing low, which is about 80. And his target would be this, which would be about 250 pips away. Now, instantly you can tell that this guy, the guy I know, a colleague, has been trading for a while, because his system is not so cramped and so convoluted as the other one. It's a set of rules, specific. This I do this when this happens, and this when that happens, and that's it. So over here, he wouldn't have got in because you can see price spiked. So then you'll say, well, what happens here? Well, here, price is below both. So he'll take a short, so long as price is, or the stochastic is looking like this, pointing downward. He'll take the shot here. And I'll talk about it later, but he kind of introduced me also to the 3-strike rule. And I'll just touch on it now, but basically if price hits the same area 3 times, you just get out of your trade. Now for him also, what he'll do is if price hits the 20, if price hits or exceeds the 20 on a short or the 80 on a long, he'll exit. He'll just take his profit or his loss and he'll exit. So in this case, actually, he probably would have just taken profit either here or here. But even if he didn't and he lagged for a little bit, he would have definitely been out here, because you'll see 1, 2, 3 times. 1, 2, 3 times price struck the same thing. So you'll see that this one he got out like right here, right about 270. Now, I'm not telling you guys to use this. I'm just showing you the difference between someone who's thought out a system using moving averages, and that it's something that can actually work and actually keep you out of trades and keep you safe. Because you see all this, he would never got into any of this. This is not a trade. None of these are trades, because he waits for price to accelerate and come back in. See, out, in. None of this. All this he would have maybe right here. Maybe he would have took a shot because it got really close, but he would end up with a loss most likely. And I mean, it's not perfect because you can just see right here, price bounced. So he'd be waiting for an entry, which would be here. And if he followed his regular rule, he would have got in here and took profit there. Because we don't know that any of this is going to happen. You see? So he would have got in here, and he would have set a target about 100 pips away, and boom, he would have got out. Now, why would he do that? Why? Because the 200 is very powerful. See? Price hits it, spikes above, doesn't quite survive. Doesn't make it. Touches it, comes back down. Touches it, comes back down. So from the history, all he can see is what has happened. Right? So he'll take the shot and get this. Now, of course, he'll be upset about all this. But the beauty is that it's going to have to come back down to meet this. You see? So this is just a very brief, I did not get into the intricacies, but the difference between a well thought out system, one that works because it has been tested, and then one where a guy named Bag of Vino says throw this one and that one together and it works on all charts and all time frames. If you ever hear somebody say this works on all charts and all time frames and it has to do with moving averages, please run away. No one, again, you cannot use the same moving average across every single time frame. That's just not how it works, ladies and germs. It just isn't. So I'm going to cut off the video here. And I want you guys to know that I'm being hard because I don't want you guys to waste money. It's very important to me that you guys don't waste money. Money in this market, money is your product. You need to protect your capital. If you burn your money, you cannot trade. I don't care how good you are. That's it. It's over for you. Okay, listen. I'm going to keep rambling, but I had enough now. My throat's starting to hurt. The moving average is a common indicator that is easy to use once you understand how. Please do your own research, demo different styles, and if you want to do moving crossovers, please do some testing first. Understand the basics, understand the market that you're trading. Don't just throw stuff together, okay? So that's it for now. If you have any questions, feel free to hit me up at bearforextrading@gmail.com. Hit me up on Twitter if you have a quick question that I can answer in 140 characters. If you are a member of Bear Forex Essentials through Patreon, feel free to give me a call at the number posted, and I'll get back to you when I can. Join me next time when I will crank it up a notch and talk about an indicator specially designed to be used with the Japanese candlesticks, the mighty Ichimoku Kinko Hayo. Until then, arigato and sayonara, bitches.